Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. It's 19th of December 2023 and here are the questions we'll be answering today. Why do airlines go bust? How can India build mega factories like China? Will Bitcoin's dream run continue in 2024 as well? And what is dry powder?
Advancing data center performance and energy efficiency to solve your most important business challenges. AMD. Together, we advance.
Engine troubles and financial crisis have pushed Go First Airline to a point of no return. Its sole potential buyer, Jindal Powers Limited, has backed out of bidding. The budget carrier looks all set to follow 12 other airlines which have flown into obscurity in the last 10 years. Foreign shores too are no less ominous for airlines. But why do so many promising airlines go bust? Kasturi Akhil and Bashar Kumar find out.
On 2nd of May 2023, India's fifth largest airline, Go First, suddenly slammed brakes on its operations and grounded 28 aircrafts. While flyers were furious at the sudden cancellation of flights and looked for answers, industry experts saw it coming. Go First was struggling to stay afloat for some time, and about half of its fleet was already grounded by then. The airline pinned the blame on US-made Pratt & Whitney engines and filed for bankruptcy protection. Over 6 months on, it is still struggling to find a bidder. The sole bidder, Naveen Jindal, backed out recently, shattering the last hope of Go First's revival. It has brought back memories of 2019, when Jet Airways had gone bust. At that time, Jet was the country's biggest airline. Its promoter, Naresh Goyal, is now in jail facing allegation of money laundering. In the last 10 years, 8 airlines have disappeared from Indian skies, and the country is staring at duopoly with Indigo and Tata Group Airlines cornering close to 89% market share. Coming back to Go First, the airline bore a hefty price for calling itself a low-cost carrier by taking on heavy debts to pay off aircraft leases, airport fees, and salaries. According to reports, Go First owed about 6,500 crore rupees to financial creditors as of April, and its total liabilities amounted to 11,500 crore rupees. India has witnessed at least 27 scheduled airlines either going bust, merging, or being acquired by another airline since 1994. So why do private airlines fail so often in India?
So there are two parts to this. One is there's a low entry cost in India. I mean, with a capital of about 6-7 million, which is almost 50 odd CR, you can start an airline. But then there's the cost of holding capacity. How much capital do you need to run the business? One is entering the business, other is running the business. And if the dependency is only on sale and leaseback model, then that creates another sort of challenge, which is what we call it becomes a supply-driven planning rather than a demand-driven planning. So you need to acquire more aircraft in order to earn more SLBs, which means you will put pressure on your yields and other factors. So the basic inherent strength of a balance sheet is not there, and as long as that is not there, you will continue to face challenges from one challenge to another, and you'll always be in a sort of a fundraising mode, if I were to put it like that.
That ever since the government allowed private sector airlines to come up in the early 90s, almost 4 of every 5 airlines have shut down. Now, this ranges from an airline operating for a few weeks, months, to Jet Airways, which operated for over 25 years and then shut down. So there are a variety of reasons for it. One, of course, being that when the government allowed the open skies policies in the early 90s, they did not set any rules. Companies which came up overnight, got into the airline business, did not know the basics of aviation industry. So they have given India a bad name. But let's take the last decade. how many airlines have shut down in the last decade? Fewer airlines have come in, and still fewer airlines have shut down. So with the result, the stability factor has now come in, maturity factor has come in into the Indian aviation industry.
Most of the now defunct air carriers have either succumbed to high operating costs, particularly air turbine fuel, which is heavily taxed. Wild swings in ATF prices, driven by a host of global and domestic factors, can wreak havoc for any airline business. Fuel constitutes 40% of the total operating cost of airlines. Another big reason, experts say, is airlines offering services at dirt cheap fares due to increased competition, which the companies offset through unbundling of airfares so as to provide passengers the option to enjoy lower and lower fares by means of depriving themselves of additional amenities. Experts believe fundamentally big players getting into the business without adequate amount of foresight and knowledge about the aviation industry have pushed the likes of Kingfisher Airlines into high levels of debt and mismanagement.
So you've got the money from the banks, you've started the airline. In trying to garner market share at the expense of profitability, you never came to know when you've exceeded your potential. Banks, which had no experience of lending to the airlines, because both Air India and Indian Airlines prior to 1990s were self-sufficient or getting money from the government. So the banks kept lending money, restructuring loans, and then we saw airlines shutting down. No, there's a factor which is called the cost of producing a seat. If you are going to charge fare for a sustained period below the cost of producing a seat, can you survive? The only thing is, there was an era in our political system where you could go to the bank repeatedly and keep getting more and more loans, like the Kingfisher example, whether it was the political pressure or other thing, but the reality is, I'm very happy that we have reached a stage where there's stability, there is maturity.
The airline collapse is not limited to India alone. Since the onset of the pandemic, as many as 64 airlines have ceased operations worldwide. Although some restored operations post-bankruptcy, a vast majority never made a comeback. According to media reports, the pandemic has been more damaging to the aviation sector than any recession, war, or terror attack. Experts agree that over the years, the Indian aviation industry has certainly matured. Today, there's more stability and fewer Indian airlines. In the last 3 years, only Akasa Air has been floated, which was backed by Rakesh Jhunjhunwala, an ace investor with deep pockets, and it is being run by seasoned professional Vinay Dubey.
Notwithstanding some airline bust, India has become the third largest domestic aviation market in the world. Boeing recently announced that it will set up its largest facility outside the US in Bengaluru. Another US giant, Apple, has emerged as the face for foreign manufacturing in India. Clearly, India is aggressively pitching itself as an Asian alternative to Chinese manufacturing. But while it has come a long way, India clearly has a long road to cover. Abhijit Kumar has more on this.
Till a couple of decades ago, major iron and steel industries would drive the regional economy and contribute to India's GDP. But we are in the age of megafactories now. Megafactories are characterized by their massive scale and high production capacity, and of course, play a pivotal role in driving economic growth of the region. China's success in this area has been unprecedented, catapulting the nation to the forefront of global manufacturing. But India is also catching up. After COVID, most Western countries are adopting China Plus One strategy, seeking alternative manufacturing sources as backups to China. Herein, India emerges as a key beneficiary, capitalizing on its unique advantages. While countries like Vietnam, Malaysia, and Mexico are vying to be the +1 destinations, India stands out due to the government's commitment to a business friendly atmosphere. This is evident from Apple scaling up iPhone manufacturing in India, showcasing India's potential to become a major manufacturing hub for MNCs. And it's not just mobile phones. India's manufacturing is also taking strides in the electric vehicle segment. With the announcement of gigafactories for production of lithium-ion batteries in India by Reliance and Adani Enterprises, tell the tale of India's expanding manufacturing prowess. According to analytics firm Counterpoint Research, India made the biggest gains in electronics, where exports have tripled since 2018 to $23 billion in the year through March. For producing 9% of the world's smartphone handsets in 2016, the country is projected to raise it to 19% this year. But the country's aspiration to replicate and exceed China's success faces a volume challenge. While the number of manufacturing factories in India has grown by more than 50% from 2010 to 2020, reaching nearly 2.5 lakhs, it still lags behind China, which has approximately 2.8 million manufacturing plants. The number of factories in India has grown since the last available data, but the massive gap appears difficult to bridge in the near to medium term.
I think the one thing that many people would agree we lack at the moment is people productivity. So while our wages today, if you look at minimum wages in most states, we are probably 1/5 of China. We are probably a little lesser than even Vietnam. And yet we are not able to drive the kind of scale that we should be able to drive at this stage. And that has to do with our manufacturing ecosystem. And I'll break that up into two parts very quickly. One is taking care of our workers. Do they have a clean place to stay in, or are they staying in slums? The conditions are not hygienic. Power supply is not 24 hours. So, dengue season, malaria season, he will be infected. There are areas where he has problems with food, the quality of food that he gets. China solved all that by putting these workers in the factory premises. Now, while that in India may not be a good idea, and plus we don't have it at the moment, we don't have the infrastructure. Even the existing industrial areas have a lot of vacant land. And I've always argued a simple policy that allows these vacant industrial plots to be converted into hostels as a business, with some code on making sure that these hostels are run well. And that will be a good starting point.
Mega factories demand a workforce with advanced technical skills. But the shortage of skilled labor in India has been a critical bottleneck to this end. While China has long outdone India by developing a skilled labor force available on relatively low wages, India has seen incremental progress on that front in recent years as well. According to the India Skill Report 2023, overall employability among young Indians increased from 46.2% last year to 50.3% this year. The employable women workforce has risen to 52.8%, surpassing the employability rate of men at 47.2%.
So if you look at skilled labor, right, one of the key issues is from a labor perspective. I mean, it's one thing to have cheap labor. The second is to have labor that is skilled and, or, at least capable of being skilled and being trained. I think that's the biggest issue that you have from an India perspective. You have enough people, but the employability is a question mark, which is why the whole effort of the government is to make them more skilled and be available and employment ready. I think that's the first part.
India's skill development landscape has also undergone policy reforms. The number of industrial training institutes, or it is dedicated to skill training, surged from 10,119 in 2014 to 14,740 in 2022, marking a 45.67% growth. Operational since 2015, 33 national skill training institutes include 19 for women. Capital expenditure poses another significant challenge. The initial investment required for mega factories is colossal, and securing funds can be an uphill task. So, how can these gaps be bridged?
Access to the credit and the amount of credit. Is because the sectors that I have met, they all have saying that don't give us this, don't give us that, but give us the access to credit because that is the interest rates are very high. And on that, many of the industry groups are asking for subvention from the government. So that's a very clear ask. Is the PLI scheme. PLI scheme has been, I think the government allocated about 1,97,000 crores for the PLI. But so far, the total payout from the scheme has been about 4 to 5,000 crores. So it has been somewhat stringent. Labor sector reforms. Government brought the labor codes, but for some reason it is stopped in gazetting the issuing the rules. I think they need to issue the rules.
When you compare ourselves with China, and they have industrial clusters. When the industrial clusters are prepared, it helps in reduction of cost, it helps in reduction of raw material cost. It is the ease of doing business. I think that is something which is very important. Land requirements. Now, if you look at it, the large contiguous piece of land is not easy in India to be acquired, and that also creates a bit of a challenge for large manufacturing units to be set up as compared to easier land acquisition laws in our neighboring country like China. The enforceability of contract, I think the exit and entry part from an exchange control law is also one of the factors.
Establishing mega factories and catching up with China is a tall order for India, but the country is making headway slowly. The key to realizing India's mega factory dreams depend on favorable policies, strategic support, and skilled workforce.
Advancing data center performance and energy efficiency to solve your most important business challenges. AMD. Together, we advance.
Let's now see what is happening in the world of digital currencies. Bitcoin has more than doubled investor money so far in 2023. However, it is expected to witness the famous halving event in April 2024, where the value of the currency nearly halves but sees multifold rise in months ahead. So will Bitcoin be able to hold on to its dream run in 2024? Puneet Wadhwa brings you this report.
After a tumultuous 2022, the poster boy of cryptocurrencies, Bitcoin has beaten all other asset classes in 2023. The cryptocurrency has surged a staggering 149% so far in 2023, hitting the $44,000 mark on its way, while Ethereum has zoomed 82% year to date. By comparison, frontline equity indices across the globe have given returns in the range of -5% to 43% during this period. Gold, silver, and platinum, meanwhile, have returned a -14% to +11% during this period. So, what helped Bitcoin recoup its previous calendar year's losses? According to analysts, the rally is partly attributed to a rise in equity markets globally despite hawkish monetary policies. That apart, reports of the launch of the world's first Bitcoin ETF over the next few months are also driving the rally. Christopher Wood of Jefferies, who recently increased his investment in Grayscale Bitcoin Trust by 1 percentage point, believes the dropping of the SEC's case against Grayscale in October suggests the path is now clear for the approval of a Bitcoin ETF. Back home, Sumit Gupta of CoinDCX expects Bitcoin ETFs to see the light of the day by early 2024, which may open floodgates of institutional capital into the asset class.
The biggest names like BlackRock, Vanguard, all of they control $15 trillion in assets. $15 trillion. So even if a small percentage of that comes to this industry, I think that's all that in itself is going to create a new wave of capital.
So, will the cryptocurrency continue its dream run in 2024?
The overall sentiment looks positive because of the conversations around ETF, and when that happens, there's a lot of new institutional capital that comes in. We know that there's trillions of dollars that may potentially come in over the years, which is going to take the market cap to a new level. So if you combine that with the technological development that's happening in terms of L2's ZK proofs, I think all of that is going to bring birth to tons of new applications which will drive real adoption over the next few years. So extremely bullish overall.
Overall, better regulatory compliance, technological developments, and institutional backing is set to propel the asset class to new highs in the coming year. Today, on 19th December, global cues and stock-specific action will guide the markets.
He's making plans for an early retirement. Business Standard.
After plowing billions of dollars into the cryptocurrency market, venture capitalists are believed to be sitting on dry powder, waiting for the right time. They've turned circumspect on startups too. But exactly what is dry powder? Vasudha Mukherjee explains.
The term dry powder refers to the cash reserves strategically maintained by corporations, private equity funds, and individual investors to use when an opportunity for strategic investment arises or during an economic downturn. The term finds its roots in 17th century military context, where gunpowder's effectiveness depended on it being kept dry. Dry powder can take the form of different assets such as cash or high liquid fixed income securities like treasuries. Some investors may also keep dry powder invested in public stocks that generally have high liquidity. Although public stocks are more volatile than cash, investors can easily sell stocks when they are in need of funds to invest in the private market. Dry powder provides companies with a competitive edge, especially during times of market turbulence. This can act as a business security fund to help corporations meet obligations, sustain operations, and potentially outlast competitors who lack financial preparedness. It also allows investors to take advantage of opportunities as they arise in the market. The corporation can maintain dry powder or build up its level when it anticipates difficult conditions arising in the near future. Maintaining a balance between dry powder and investments is crucial as excess reserves can limit expansion. Dry powder can also provide a company an advantage when negotiating credit flow. Financial institutes assess a firm's ability to repay debts during loan applications. High cash reserves or dry powder can help streamline credit facilities to firms. For venture capital funds or private equities, dry powder can refer to funds that have been raised but are yet to be invested. For private equities and venture capitalists, more dry powder means more potential for money flows into the private market. This also means firms seeking investment have more opportunities to attract that cash. However, high levels of dry powder may also be a sign that investors are being cautious and may be waiting for market conditions to improve before deploying funds. Maintaining low levels of dry powder would make it difficult for both investors to jump on good investment opportunities and for firms to attract investment. Conversely, investors may find themselves with excess dry powder if attractive deals are scarce in the market. Concept of dry powder can be applied to individual investors. Financial advisors generally advocate maintaining a portion of assets in cash reserves or in high liquid securities like public stocks or bonds. This can act as a safety net during market corrections.
I will achieve. I will fly high. I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
BlackRock recently estimated that the private capital industry's dry powder has touched the 4 trillion mark, enough to buy out US giant Apple. Well, that's all for today. For more news, views, and insight, please log into business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.